Investing is not just about money. It's about understanding the deeper psychology of value, timing, and belief. Most people chase returns, looking for the next hot stock or the next trending crypto coin. But real investors play a different game. They don't run after money, they make money work for them. They understand that wealth is built not in a moment, but over time through consistent action, patience, and discipline. The real game of money isn't fast, it isn't flashy, it's strategic. It's about thinking long-term when everyone else is chasing the short term. It's about staying calm when others panic and buying when others are afraid. This is the mindset that separates investors from gamblers. Wealth is built through ownership, not labor. That statement alone challenges everything most people are taught growing up. From childhood, society tells us that hard work is the path to success. Go to school, get good grades, land a high-paying job, work tirelessly, and eventually you'll be successful. But the truth is, labor alone has never created generational wealth. Ownership has. The people who control assets, who own businesses, stocks, real estate, or intellectual property are the ones who accumulate real, lasting wealth over time. Labor earns a wage, ownership builds equity. Labor stops paying you the moment you stop working. Ownership keeps paying you, often even when you're sleeping. The rich understand this game. They buy assets that grow. They invest in systems that run with or without them. They earn not just from their own effort, but from the efforts of others. And the movement of money. The poor and middle class, on the other hand, are often stuck in a cycle of trading time for money. And time is limited. No matter how hard you work, there are only 24 hours in a day. Ownership breaks that limit. It scales, it multiplies, it compounds. You can own something that makes money while you're spending time with family, sleeping, traveling, or even recovering from failure. That is the true power of ownership. Look at the wealthiest people in any country. They are not the hardest workers physically. They are not the ones doing the most overtime. They are owners. They own companies. They own shares. They own land. They own rights to products and content. And even when markets crash or things get tough, they still have equity. They still have leverage. Ownership gives you leverage. It means your effort and money are no longer tied only to your direct actions. With ownership, one good decision can create income for years. One investment can change the direction of your financial life. People often say, "I don't have the capital to invest." But ownership doesn't always start with money. Sometimes it starts with mindset. It starts with the decision to stop consuming and start building. You can build digital products, write books, create courses, learn stock investing, start small businesses. Every time you create or acquire something that earns without constant input, you're stepping into the world of ownership. The shift from consumer to owner is the turning point. Most people spend their money buying liabilities, things that look good or feel good temporarily, but don't produce income. Owners spend their money on assets that generate cash flow or appreciate in value. They think long-term while others live paycheck to paycheck. Even if you have a job, the goal should be to use that income to buy ownership. Let your job fund your investments, not your lifestyle. Let your paycheck become a tool for ownership, not a trap for spending. The majority live for weekends and holidays because their time is not their own. Owners choose how they spend their days because their money works for them. That freedom is not earned through promotions. It's earned through ownership. Real estate is one powerful example of this. When you own property and rent it out, that rent becomes income whether you're present or not. It continues to flow. Stocks offer another form. When you buy shares of a company, you become a partial owner. Dividends and appreciation build your wealth silently in the background. You don't need to run the company to benefit. The business world becomes your field of opportunity without requiring your constant involvement. Ownership connects you to larger systems. It multiplies your power. The truth is, even the highest-paying jobs rarely produce real wealth unless the income is invested. Because high income without ownership still equals dependence. One job loss and everything collapses. Ownership creates resilience. It provides layers of income, backup plans, and long-term security. The investor who owns 10 properties can lose one and still survive. The employee who loses one job loses everything. That is the risk of relying only on labor. Owning a business may be more work in the beginning, but it is a seed that grows into a tree. At first, it may seem small and vulnerable, but with consistent effort, it can generate more than any salary. Entrepreneurs understand this. They are willing to take the upfront pain for the long-term gain. Every time you build something you own, you create a system that can someday free you. That could be a brand, a product, a service, or even intellectual property like music, books, or software. The opportunities are endless. The digital age has made ownership even more accessible. You can buy fractional shares of companies, invest in real estate funds, create content that generates royalties, build online stores, or license your work. You no longer need to be born rich to become rich, but you do need to think like an owner, not a laborer. The mindset must change. Labor is honorable, but ownership is powerful, and both together can accelerate your path to wealth. Use labor as a stepping stone, not a life sentence. The school system often fails to teach this truth. It trains students to become good employees, not powerful investors. It teaches memorization, not wealth creation. That's why financial education is so important. You must teach yourself what school didn't. You must study how money really works. You must observe what the wealthy do and replicate it in your own way. Ownership is not a mystery, it is a strategy. It is available to anyone willing to learn, sacrifice, and stay consistent. This is why so many people work for years and still struggle financially. Because effort without equity leads to exhaustion. They give their energy to someone else's dream while ignoring their own. The world doesn't reward work alone, it rewards results. And results come from assets that grow and produce value. Owners understand the game. They see beyond today's paycheck. They plant seeds for tomorrow. If you want to build wealth, start asking yourself, what do I own that is growing? What have I created or acquired that pays me over time? What income sources have I built that don't rely on my physical presence? If the answer is none, then you're not playing the real game of money yet. But you can start now. Ownership begins with a decision and grows with action. The real investors, the real players of wealth, they don't hustle forever. They build machines that do the hustling for them. They build portfolios. They buy or create income streams. They focus less on impressing others and more on building leverage. This is the real game of money, and until you step into ownership, you're only watching others play it. Time in the market beats timing the market. The simple yet powerful principle separates real investors from emotional speculators. Many people waste years trying to guess the perfect time to enter or exit the market, waiting for the ideal dip or the next big rally. But history has consistently shown that those who stay invested and let time do its magic often outperform even the smartest market timers. Investing is not about predicting moments. It's about participating in momentum over the long term. The market rewards patience more than precision. While the desire to buy low and sell high is natural, it's also unrealistic to do so consistently. Timing the market requires being right twice, when to get in and when to get out, and even the most seasoned investors rarely succeed at both. One wrong move, one missed rally, or one unexpected downturn can wipe out years of effort. On the other hand, being in the market long enough allows compounding to take effect. A small investment left alone for a long period can outperform a large investment that's constantly moved in and out of the market. The reason is simple. Compounding grows not just your money, but the returns on your returns. Time multiplies wealth in a way that no short-term strategy can match. Volatility is part of the journey. Markets will rise and fall. Corrections will happen. Crashes will come. But history shows that markets recover, and over time they trend upward. Those who panic and pull out often lock in losses and miss the rebounds. Those who stay in, even through downturns, are often rewarded in the long run. The real game of money is not about trying to outsmart the market, but about outlasting it. Emotional decisions, driven by fear or greed, are the enemy of consistent growth. The disciplined investor, who trusts the process and focuses on time over timing, builds quiet and powerful wealth. Every market cycle brings temptation. During booms, people feel like they're missing out and jump in at the top. During crashes, fear drives them to sell at the bottom. This behavior destroys value. The wise investor sticks to the plan. They understand that market cycles are part of the process, not interruptions. A long-term view transforms chaos into opportunity. It turns short-term noise into long-term gains. It allows you to see dips as discounts, not disasters. Investing is less about predicting the next move and more about preparing for a lifetime of moves. The person who understands this plays the real game of money with clarity and confidence. Even small differences in time can make a massive impact. Starting 10 years earlier, even with a smaller amount, can lead to much greater wealth. Due to compounding, time amplifies growth. It turns ordinary savings into extraordinary results. But time can't be replaced. Once lost, it's gone forever. That's why delaying investing is one of the biggest financial mistakes. People wait for higher salaries, better markets, or perfect conditions. But perfection never arrives. The best time to invest is always as early as possible. Let your money start working now, even if it's just a little. The magic happens not in the size of your investment, but in the duration of it. Another reason time in the market matters more is because no one can consistently predict short-term movements. The market reacts to countless variables: economic reports, geopolitical events, investor psychology, and technological shifts. These factors are unpredictable. Trying to guess the market is like trying to catch a falling knife or chase a shooting star. But when you zoom out, the trend becomes clear. Despite wars, recessions, and crises, the market has continued to grow over decades. Long-term investors don't fear downturns, they see beyond them. They understand that time is their most loyal ally in building wealth. Some people get discouraged by short-term losses, forgetting that every major index has risen significantly over the long run. The S&P 500, for example, has delivered solid returns over multi-decade periods despite experiencing crashes along the way. Those who stayed invested through the storms saw their portfolios recover and grow. Those who jumped in and out often missed the strongest days of recovery. Missing just a few of the best days in the market can drastically reduce your overall returns. And the problem is, those days are impossible to predict. They often come right after the worst days. The only way to catch them is to stay in the market. This is why investing is not just financial, but psychological. It requires faith in the long term, patience during uncertainty, and discipline when emotions scream otherwise. Time in the market requires trust in your strategy and a refusal to be shaken by temporary noise. It's not exciting, it's not dramatic, but it works. The investor who quietly contributes to their portfolio month after month, year after year, will often outperform the one chasing quick wins. The game of money is not about speed, it's about endurance. Even professional fund managers often underperform the market because of frequent trading and attempts to time moves. Individual investors who simply invest in broad, diversified index funds and hold over time often do better. Why? Because simplicity and time outperform complexity and timing. You don't need to be a genius to build wealth. You need to stay invested. You need to resist the urge to outsmart the system. You need to let time and compounding do the heavy lifting. Retirement security, financial freedom, and generational wealth are all built on the foundation of time in the market. They are not the result of brilliant predictions, but of steady, consistent investing over decades. The earlier you start and the longer you stay, the greater your results. This principle applies regardless of income level. Whether you're investing a small portion of your salary or managing a large portfolio, time multiplies your impact. The market rewards those who respect the long term and ignore the temptation of fast money. The real game of money is not about finding the next big thing. It's about owning good assets and giving them time to grow. It's about trusting that the economy, innovation, and progress will continue to push value upward over time. It's about believing in the future and planting seeds today for a harvest you may not see tomorrow, but will surely come. Those who master this mindset don't just build portfolios, they build peace of mind. They don't live in fear of the next market crash, because they know crashes are temporary, but time is permanent. The power of investing is not found in magic formulas or complex strategies. It is found in simple, consistent action repeated over long periods. Time is the greatest multiplier of wealth and the greatest equalizer of opportunity. No matter where you start, time levels the field if you stay committed. If you truly wanted to play the real game of money, stop looking for the perfect moment and start embracing the power of time in the market. Real investors focus on value, not hype. That one sentence is the dividing line between people who build lasting wealth and those who chase temporary excitement. In the world of investing, noise is everywhere. Every day there's a new trend, a new hot stock, a new cryptocurrency that's going to the moon. Social media floods us with stories of overnight millionaires, influencers making wild predictions, and platforms promising sky-high returns with zero risk. But real investors don't get distracted by the noise. They don't follow the crowd. They follow the numbers, the fundamentals, the truth beneath the surface. Because hype is temporary, but value is timeless. Value is what a business or asset is truly worth based on its ability to generate income, its competitive advantage, its leadership, its financial health, and its long-term growth potential. Hype is what people say it's worth based on emotion, excitement, or speculation. Hype comes and goes like a wave, but value is the ground beneath the ocean. When you invest in value, you're building on something real. When you invest in hype, you're gambling on emotion. One makes you rich slowly and surely. The other can make you broke quickly and painfully. The most successful investors in history, from Warren Buffett to Benjamin Graham, have all focused on value. They look at companies the way owners do. They don't ask what the price is today, they ask what it's worth in the long run. Is the company profitable? Does it have consistent earnings? Does it have a strong brand, loyal customers, and a clear future? Real investors do their homework. They read financial statements. They evaluate business models. They look at debt levels, management decisions, and competitive positioning. They know that the market may misprice things in the short term, but over time, value always wins. The problem is that hype feels good. It's exciting. It creates urgency. It tells you you're missing out. It makes you emotional, and emotion is the enemy of smart investing. When people invest in hype, they're not thinking clearly. They're chasing the crowd. They buy high out of fear of missing out and sell low out of panic when the hype fades. That's how bubbles are formed and how fortunes are lost. Real investors remain calm. They don't care if something is trending. They care if it's undervalued. They don't ask what's hot, they ask what's worth it. Value investing requires patience. It means buying what others are ignoring and holding it through ups and downs. It means staying loyal to the fundamentals even when others are chasing fads. It's not glamorous. It doesn't give you the thrill of fast gains, but it builds real, lasting wealth. Because companies with strong fundamentals survive. They grow. They recover from crashes. They pay dividends. They adapt to markets. Hype-driven investments often don't even have a business model. They have a story, not a structure. They have excitement, not earnings. They're built on hope, not performance. One of the biggest mistakes new investors make is thinking that price equals value. Just because something is expensive doesn't mean it's valuable. And just because something is cheap doesn't mean it's a bargain. Real investors look deeper. They calculate intrinsic value, the actual worth of an asset, based on its fundamentals. If the market price is below that, they buy. If it's above that, they wait. This is where discipline comes in. It's easy to jump into a trending stock when everyone is talking about it. It's harder to invest in a quiet, undervalued company that nobody is excited about. But history has shown that those quiet companies often deliver the best returns. Value investing is also about margin of safety. Real investors never assume they're perfectly right. They build a cushion into their decisions. They buy assets at a price low enough that even if things go slightly wrong, they're still protected. That's what separates investing from gambling. Gamblers bet everything on a single roll. Investors build protection into every move. They don't chase hype because they know hype gives no safety. It's all or nothing, and usually, it ends in nothing. In the real game of money, success is about strategy, not emotion. It's about knowing that the crowd is often wrong, that markets overreact, that popularity doesn't equal profitability. That short-term trends are just that short-term. Real investors understand cycles. They know that hype comes in waves, but value compounds. They choose the slow, steady road over the risky roller coaster. They build portfolios with purpose, not with excitement. They're not looking to brag about a lucky trade, they're looking to retire free, provide for their families, and leave a legacy. The rise of social media and online investing platforms has made hype more dangerous than ever. Now anyone with a phone can promote a stock, start a rumor, or create a panic. Viral videos and tweets can cause massive price swings in minutes, but none of that changes the fundamentals. A business's real value doesn't change just because a trend is going viral. Real investors know how to filter noise. They focus on what matters: earnings, cash flow, return on equity, leadership quality, industry position. These are the truths that remain long after the hype has faded. This doesn't mean you ignore opportunities. It means you measure them. You investigate before you invest. You don't let emotion control your wallet. You let logic guide your decisions. Value investing isn't about being boring, it's about being wise. It's about protecting your money while growing it. It's about choosing freedom over thrill. Hype fades, but value remains. It stays when the excitement is gone. It pays when others have left. It builds when others are busy reacting. In every bull market, you'll see hype take over. You'll hear stories of people turning small amounts into fortunes overnight. You'll feel the pressure to jump in. But remember this, for every person who got lucky, there are thousands who lost because they followed hype instead of value. The stories you don't hear are the people who bought at the peak and sold at the bottom. The people who trusted excitement over evaluation. Real investors stay silent during the noise. They observe. They analyze. They act when the numbers say go, not when the crowd does. The greatest wealth is built quietly. It's not found in headlines. It's found in portfolios that grow year after year through sound judgment and timeless principles. If you want to win the real game of money, train your mind to look past the noise. Focus on value. Learn how to find it, how to measure it, and how to hold it. The market may distract you with shiny things, but true wealth is found in the substance beneath the surface. Let others chase hype. You stay focused on value. That's the mindset of a real investor. That's how the real game of money is played. Discipline is more important than intelligence. This truth is often overlooked in the world of investing, where people assume success is reserved for those with complex strategies, financial degrees, or extraordinary IQs. But time has proven, again and again, that those who consistently follow a plan, control their emotions, and stick to sound principles outperform those who try to outsmart the market. The game of money is not won by brilliance alone. It's won by behavior. The investor who has average intelligence but strong discipline will almost always outperform the genius who lacks self-control. Discipline is what keeps you investing month after month. Even when the market looks scary, it's what prevents you from panic selling during a crash or chasing hype during a rally. It's what reminds you to think long-term when everyone else is chasing quick profits. The market is not a game of instant rewards. It's a marathon that tests your patience, your resilience, and your ability to stay calm under pressure. Intelligence can help you understand the market, but only discipline allows you to stay in the game long enough to benefit from it. Many smart people fail at investing because they allow emotions to take over. They react to fear, greed, excitement, and uncertainty. They overthink, second-guess, and jump in and out of positions without a clear plan. Intelligence without discipline leads to inconsistency. It leads to constant strategy changes, impulsive decisions, and regret. The real winners are those who develop rules and follow them. They create a system and stick with it. They don't get distracted by noise. They stay focused on the bigger picture. Investing requires emotional control. The market will test your patience. There will be crashes, corrections, and bear markets. Prices will fall. News will be negative. Your portfolio may shrink. Without discipline, these moments can shake your confidence and lead to bad decisions. But with discipline, you'll understand that these periods are normal. You'll know that volatility is part of the process. You'll stay invested, relevance if needed, and wait for recovery. That ability to stay calm when others are panicking is not a result of intelligence, it's the fruit of discipline. Consistency is one of the most powerful forces in investing. Small amounts invested regularly can grow into large sums over time. But consistency requires discipline. It means prioritizing your future over your present desires. It means delaying gratification. It means sticking to your contributions even when life gets busy, uncertain, or tempting. Many people know what to do but fail to do it, not because they're not smart enough, but because they're not disciplined enough. Knowing is not enough. Doing makes the difference. The market rewards those who are steady. It punishes those who are erratic, jumping in and out, chasing returns, reacting emotionally. These behaviors destroy value. A disciplined investor doesn't make decisions based on the headlines of the day. They follow their long-term plan. They've decided in advance how much to invest, where to invest, and when to review. They're not guessing, they're executing. That quiet, consistent execution builds wealth far more effectively than complex theories that are never implemented. Discipline also protects you from lifestyle inflation. As your income grows, it's tempting to spend more, upgrade everything, and delay investing. But disciplined investors don't increase spending just because they can. They stay focused on their financial goals. They know that every extra dollar spent today is a dollar that's not compounding for tomorrow. They practice intentional living. They live below their means, not out of fear, but out of strategy. They prioritize freedom over luxury, control over impulse, wealth over status. In times of market euphoria, discipline keeps you grounded. When everyone is making money and hype is high, it's easy to abandon caution. But disciplined investors don't let greed control them. They remember that trees don't grow to the sky and that markets move in cycles. They protect their capital. They avoid unnecessary risks. They stick to their asset allocation. They rebalance when needed, even if it means selling winners and buying underperformers. This goes against human instinct, but is essential for long-term success. In times of loss, discipline becomes even more critical. Watching your portfolio drop can be emotionally painful. It can make you question everything. But this is where discipline shows its true strength. A disciplined investor doesn't sell in fear. They don't abandon their plan because of temporary pain. They hold, they analyze, they stay the course. They know that downturns are temporary, but regret from poor decisions can last much longer. That calm, rational approach comes not from superior intelligence, but from trained discipline. Discipline also leads to better research. Instead of chasing tips or reacting to news, disciplined investors study what they invest in. They look at fundamentals. They understand the risks. They build diversified portfolios that reflect their goals and risk tolerance. They don't invest out of emotion. They invest out of purpose. This thoughtful, structured approach minimizes mistakes and maximizes clarity. It's not flashy. It doesn't make headlines, but it works. Even when it comes to learning, discipline outshines intelligence. The person who reads one investing book every month for 3 years will know more and likely perform better than someone who crams advanced knowledge in a weekend and forgets it. Real understanding comes through repetition, reflection, and practice. Discipline creates habits. Habits shape actions. Actions produce results. In the real game of money, habits beat talent every time. There will always be someone smarter, faster, or more connected. But none of that matters if they lack discipline. The market doesn't care about your IQ. It cares about your decisions. Your ability to stay focused when others lose control. Your ability to follow through when it's not easy. Your willingness to be boring when others want excitement. That's what builds real wealth. The disciplined investor plays the long game. They understand that success is not measured in days or months, but in decades. They don't seek shortcuts. They don't panic. They keep moving forward, one step at a time. That slow, steady approach might not seem impressive on the outside, but over time, it leads to results that others envy. Because discipline compounds just like money does. The more you practice it, the stronger it becomes. And the stronger it becomes, the more powerful your investing becomes. In the end, intelligence can give you ideas, but only discipline turns those ideas into action. Discipline is what gets you started and keeps you going. It's the quiet strength behind every successful investor. It's the edge that doesn't fade. It's the trait that keeps you winning long after others have burned out. In the real game of money, discipline is your most valuable skill. It's what turns potential into performance and dreams into results. Money grows where emotions are controlled. In the world of investing, this single principle is the dividing line between those who build wealth and those who lose it. The market is not just a system of numbers and charts, it's a reflection of human behavior. And that behavior is largely driven by emotion. Fear, greed, impatience, doubt, and overconfidence constantly influence decisions. The investors who learn to master their emotions rather than be mastered by them are the ones who succeed. Investing is not just a financial game, it's a psychological one. And in that game, emotional control is more valuable than any technical skill. When markets rise quickly, greed takes over. People rush in, fearing they'll miss out on easy profits. They buy high, ignoring fundamentals, convinced that prices will keep climbing. They become emotionally attached to momentum and let hype dictate their actions. On the other hand, when markets fall, fear floods the system. Investors panic. They sell low, driven not by logic but by emotion. This cycle repeats over and over. And every time, emotional reactions lead to financial loss. Those who learn to stay calm, to act based on strategy rather than emotion, consistently outperform those who react impulsively. Controlling emotions doesn't mean being cold or detached. It means being aware of your natural reactions and not letting them dictate your behavior. It means recognizing fear and choosing patience. It means seeing greed and choosing discipline. The best investors are not emotionless, they are emotionally intelligent. They know their triggers. They have a plan, and they stick to that plan regardless of how they feel in the moment. They understand that reacting to short-term market noise only damages long-term results. In investing, the biggest enemy is often the person in the mirror. You can't control the market, but you can control how you respond to it. You can't control global events, economic cycles, or investor sentiment, but you can choose to remain consistent. When prices drop, your emotions scream at you to exit, to protect yourself. But the real investor knows that downturns are temporary, that wealth is built through endurance, that the best opportunities often come during times of fear. Controlling your emotions allows you to buy when prices are low and to hold when others are panicking. Greed is just as dangerous. It blinds judgment. It causes people to abandon sound principles in search of quick gains. They over-leverage, overtrade, or chase speculative assets with no intrinsic value. Greed creates bubbles, and bubbles always burst. Emotional investors ride the wave up and get crushed on the way down. But those who control their desire for fast success stay grounded. They stick with what they understand. They focus on long-term value. They don't let excitement lead them into poor decisions. They grow slowly, steadily, and securely. A disciplined investor doesn't make decisions based on headlines. They don't shift their strategy because of the latest news or market trend. They follow a plan built on research, logic, and time-tested principles. Their emotions may still arise: doubt, fear, uncertainty, but they don't act on them. They sit with those emotions, acknowledge them, and then return to their strategy. This emotional distance from their money doesn't mean they don't care. It means they've learned to protect their wealth from impulsive decisions. The most dangerous moments in investing often feel the most emotional. A sudden crash, a major political event, a global crisis. These trigger fear and anxiety. But history has shown that markets recover. Every crash is followed by recovery. Every panic eventually passes. Investors who sell in fear lock in losses and miss the recovery. Those who hold, who stay calm and trust the long term, come out ahead. It's not luck. It's emotional control, and that control is what allows money to grow uninterrupted. The same principle applies. During booms, when everyone is getting rich quickly, it's hard to stay disciplined. It's hard not to throw your strategy away and chase the hottest stock or coin. But that's exactly when emotional control matters most. It keeps you from entering the game too late. It protects you from the crash that follows the hype. Emotional investors may win for a moment, but disciplined investors win for life. Money requires respect, and respecting your money means managing your emotions around it. It means recognizing that investing is not entertainment. It's not a game of guesses or feelings. It's a long-term commitment to growth through patience and strategy. You don't need to be the smartest investor in the room. You just need to be the most consistent. And consistency is only possible when emotions are managed properly. This emotional mastery isn't automatic. It must be trained. It comes from experience, education, and reflection. It's built through mistakes, through learning when not to act, and through understanding your personal tendencies. Some people are naturally anxious. Others are overly confident. Knowing yourself is step one. Building guardrails, automated investments, clear rules. Accountability helps you protect yourself from yourself. The best investors design their systems in a way that emotion has little power over their decisions. Emotional control also means accepting that losses happen. Every investor loses money at some point, but how you respond matters more than the loss itself. Emotional investors dwell, spiral, and stop investing altogether. Calm investors analyze, learn, and keep going. They don't let a temporary setback become a permanent exit. That resilience comes not from being emotionless, but from having emotional awareness. They feel the loss, but they don't let it define their behavior. Money grows where emotions are not allowed to interrupt the process. Compounding works best when it's left alone. Constant changes, reactions, and emotional trades disrupt that growth. The longer you can stay invested with a clear mind and a steady plan, the greater your results. Wealth is not built in moments of emotion. It's built in years of consistency. And that consistency depends entirely on emotional control. In the real game of money, intelligence helps you choose good investments, but emotional control helps you keep them through the storms. It helps you stay invested when your emotions beg you to run. It helps you take action when the world is afraid. It helps you stay humble when your portfolio is growing fast. This balance, this ability to think clearly in both fear and excitement, is what defines a real investor. The market does not reward emotion. It rewards strategy, patience, and resilience. Emotional investing is chaotic and unpredictable. Controlled investing is stable and powerful. You don't need to predict the future. You just need to protect your plan from your feelings. Master your emotions, and you master your money. That's how the real game of money is played in one. Consistency wins over intensity in investing. This truth lies at the heart of wealth creation and separates those who build enduring financial success from those who burn out chasing quick results. The financial world often celebrates bold moves, dramatic trades, and massive gains in short periods. But the real magic happens quietly through repeated, steady actions. It's not the "what-I'm big" investment that changes your life, but the habit of consistent contributions, the regular discipline of putting money to work month after month, year after year. The market rewards those who show up with discipline, not those who try to impress with flashy decisions. Most people approach investing with intensity at first. They get excited after hearing a success story or seeing someone else make money. Fast, they throw a big chunk of money into something they barely understand, hoping for quick returns. But as soon as the market dips or the hype dies down, they lose interest. That intensity fades, the commitment dissolves, and with it, their opportunity to build real wealth disappears. On the other hand, the consistent investor keeps moving forward. Regardless of the noise, they don't rely on motivation, they rely on routine. They automate their investments, follow a simple plan, and let time do its work. Compounding does not reward bursts of energy. It rewards time and patience. When you invest a small amount consistently, that money starts to grow, and as it grows, it begins to earn on itself. This cycle, when left undisturbed, creates exponential results. A few $100s a month, invested faithfully over decades, can turn into a substantial fortune. That outcome has little to do with intensity and everything to do with consistency. Even if you start with less money or a lower income, steady investing will often beat sporadic big bets. Consistency builds habits, and habits shape outcomes. A person who consistently invests becomes someone who sees the long-term picture. They don't panic during downturns because they've trained themselves to think beyond the moment. They aren't distracted by market fads because they know the power of showing up repeatedly. This mindset is more valuable than any stock tip or market prediction. It transforms investing from a stressful activity into a steady process. It removes the emotion and replaces it with logic. Intensity, while powerful in short bursts, is unpredictable. It depends on energy, excitement, and often ego. Intense investors try to time the market, pick winners, or follow trends without understanding the risks. They may hit some wins, but without consistency, those wins don't lead to long-term wealth. More often, intensity leads to burnout, regret, and financial loss. The market is not a sprint, it's a marathon. And marathons are not won by sprinting at the start, they're won by pacing yourself and finishing strong. The consistent investor embraces simplicity. They often invest in diversified index funds or portfolios aligned with their goals. They don't need to watch the market every day because they trust the process. They don't react emotionally to volatility because they understand that ups and downs are normal. Their strategy is not built on excitement, it's built on endurance. That endurance is what gives them an edge over others who might be smarter, richer, or more connected. Because while those people may come and go, the consistent investor stays in the game. Even when the market underperforms or goes through a rough season, the consistent investor continues to contribute. This behavior is powerful because investing through downturns often leads to buying at lower prices. When the market recovers, those consistent purchases increase in value, creating even stronger gains. It's not about perfect timing, it's about persistent effort. The more time you spend in the market and the more regularly you invest, the more the market works in your favor. Consistency also strengthens your mindset. It trains you to focus on what you can control: your actions, your contributions, your attitude. You can't control the market, but you can control your consistency. You can choose to invest this month, just like you did last month, regardless of what's happening in the economy. That choice builds financial resilience. It creates a sense of ownership over your future. It empowers you to face challenges with clarity and commitment. Financial goals are not reached through one-time intensity. They are achieved through thousands of small decisions made consistently. The decision to invest rather than spend. The decision to stay the course rather than panic. The decision to trust the process rather than chase shortcuts. These choices may seem small in the moment, but they add up over time. They shape your financial destiny. The investor who honors these small decisions consistently becomes unstoppable. It's easy to admire someone who made a lot of money quickly, but look deeper, and you'll find that most lasting wealth stories involve decades of consistent investing. They involve people who kept showing up, even when life got tough. People who stayed focused while others got distracted. People who believed in the power of time and discipline. These investors didn't let a single year define their journey. They didn't let fear stop them or excitement rush them. They kept walking the path, one step at a time. In a world obsessed with instant results, consistency feels slow, but that's where its power lies. It works quietly in the background, building layer upon layer, until one day the results become undeniable. The portfolio that once looked small becomes significant. The progress that once felt slow becomes exponential. The investor who once felt behind is now ahead, not because of a lucky break, but because of steady effort. Consistency also builds confidence. The more you invest, the more comfortable you become. The more experience you gain, the more clarity you develop. You stop doubting the process and start trusting it. You stop reacting and start planning. Your knowledge grows, your mindset evolves, and your decisions become sharper. This personal growth is just as valuable as the financial growth it brings. It shapes you into a wiser, calmer, and more strategic investor. In the real game of money, the ones who win are not always the fastest or the flashiest. They are the ones who keep going, the ones who stay steady through storms and sunshine, the ones who choose consistency over intensity every time. They know that wealth is not an event, it's a journey, and that journey is paved not with explosions of effort, but with daily decisions, steady contributions, and the quiet confidence of those who understand the real rules of the game. Financial literacy is your greatest asset. In a world where money flows constantly, where decisions about earning, spending, saving, and investing shape your life every day. Understanding how money works is the most powerful tool you can own. It is not enough to make money, you must know how to manage it, protect it, grow it, and make it work for you. This knowledge is what separates those who live paycheck to paycheck from those who achieve financial independence. Financial literacy gives you control over your future, clarity in your choices, and confidence in your investments. Without it, even large incomes can vanish and even small fortunes can be lost. Many people think financial literacy is only for professionals, accountants, bankers, or stock analysts. But in reality, it's for everyone. Every person makes financial decisions daily. What you buy, how you budget, what you save, where you invest, how you plan for emergencies, and how you prepare for the future. All of these actions are part of your financial life. Without understanding these decisions, you're left vulnerable to debt, bad investments, scams, and missed opportunities. But when you're financially literate, you become empowered. You know how to ask the right questions. You understand the risks. You see through the hype and make decisions based on logic and knowledge, not emotion and impulse. In the game of money, those who lack financial literacy often become victims of it. They chase fast returns without understanding the risks. They borrow without considering interest or repayment. They buy things they can't afford to impress people they don't know. They invest in what's popular instead of what's valuable. They think income equals wealth and assume more money will solve all problems. But without literacy, more money simply means bigger mistakes. The truth is, your ability to handle money wisely matters far more than how much you make. That's why so many lottery winners go broke and so many average earners retire wealthy. It's not the income, it's the literacy. When you understand how money works, you begin to see the bigger picture. You learn that wealth isn't built by luck, but by consistent habits. You understand the power of budgeting, how every dollar has a job, and how controlling your spending is the first step to building wealth. You grasp the difference between assets and liabilities, and why owning things that produce income is more important than owning things that impress others. You see that saving is not about depriving yourself, but about buying freedom, and you realize that investing is not gambling, it's a strategy built on research, patience, and long-term vision. Financial literacy transforms how you see time and money. You learn that the earlier you start, the more powerful your results become. Compounding rewards those who begin today, not someday. A financially literate person knows that small, regular investments can grow into massive outcomes. They understand how interest works, how inflation erodes purchasing power, and why putting money under the mattress is not a strategy. They study how different investment vehicles work: stocks, bonds, mutual funds, real estate, index funds, and how each plays a different role in building wealth. They know their risk tolerance, investment horizon, and financial goals, and they align their actions with those realities. Being financially literate also protects you. It protects you from debt traps, from high-interest loans, from emotional spending, and from financial stress. It allows you to build an emergency fund that keeps you afloat during unexpected challenges. It helps you avoid financial decisions made out of panic or pressure. It teaches you the importance of insurance, the role of taxes, and the value of retirement planning. Financial literacy is not just about growing money, it's about keeping it, managing it, and using it wisely across every area of life. In investing, financial literacy is your compass. It keeps you grounded when markets are volatile. It helps you avoid hype and stay focused on fundamentals. It teaches you to ask what something is really worth, not just what it costs. A financially literate investor doesn't panic during a market crash. They understand that downturns are part of the cycle. They don't chase get-rich-quick schemes. They know real wealth takes time. They don't put all their eggs in one basket. They diversify with intention. Financial literacy provides the tools to analyze opportunities and the wisdom to walk away when things don't make sense. More importantly, financial literacy brings peace of mind. When you know where your money is going and how your future is being shaped, you carry less anxiety. You're not stuck wondering how to pay bills or cover emergencies. You're not living under the constant pressure of debt. You're not afraid to check your bank account. You make choices from a place of power, not desperation. you build not only wealth but confidence and independence. That peace is priceless, and it's available to anyone who takes the time to learn. This is why financial literacy is not optional, it's essential. It's not something you master in a weekend, but something you build step by step, reading books, watching educational videos, talking to mentors, tracking your spending, reviewing your investments. Every small action adds to your literacy. The more you learn, the better you get, and as your knowledge grows, so does your ability to take control of your financial life. No one can do this for you. You have to become your own financial expert, your own advocate, your own planner. Because, in the end, it's your money, your future, and your responsibility. The real game of money is not played by the richest, but by the wisest. It's not about flashy purchases or complex strategies. It's about understanding the rules, avoiding the traps, and making the most of what you have. Financial literacy is not about being perfect, it's about being aware, informed, and intentional. It turns confusion into clarity. It transforms fear into confidence. It takes people from just surviving to truly thriving. In a world that constantly pulls you toward consumerism and chaos, financial literacy is your armor. It helps you say no to the unnecessary and yes to the meaningful. If you want to succeed in investing, don't just chase profits, build understanding. Don't just look for shortcuts, build habits. Don't rely on luck, rely on knowledge. Financial literacy is not a luxury. It's not a side topic. It is the foundation. Without it, every decision becomes a guess. With it, every decision becomes a step toward freedom. That's why in the real game of money, your greatest asset isn't a stock or a strategy. It's your financial literacy. Because once you own that, you can build wealth in any market, at any time, starting from anywhere. Risk is not to be feared, but managed. In the world of investing, risk is inevitable. Every opportunity to grow your money carries with it some level of uncertainty. There is no such thing as a completely safe investment, just as there is no reward without some exposure to risk. The key to success is not in avoiding risk altogether, but in understanding it, preparing for it, and managing it wisely. The greatest investors are not those who run from risk, but those who respect it, study it, and use it to their advantage. Fear of risk often paralyzes people. It keeps them stuck in financial comfort zones that ultimately limit growth. They avoid investing because they worry about losing money. They hoard cash, keep savings in low-yield accounts, and let inflation quietly erode their purchasing power. What they don't realize is that playing it too safe is also a risk, just a different kind. It's the risk of missed opportunity, of future scarcity, of not building enough wealth to achieve true freedom. Risk can't be eliminated, but it can be controlled, and once it is understood, it becomes a tool, not a threat. Managing risk starts with education. When you understand the nature of different investments, you can match your strategy to your personal risk tolerance and long-term goals. Stocks, bonds, real estate, mutual funds, ETFs all carry unique risk profiles. Some are more volatile, others more stable. Some grow faster but swing wider. Others grow slower but offer steadier returns. A financially literate investor doesn't blindly throw money into the market. They assess the risk and make choices that reflect both their ambitions and their comfort levels. This alignment is what allows risk to become a manageable force rather than a source of fear. Diversification is one of the most powerful tools in managing risk. By spreading your investments across different asset classes, industries, and geographies, you reduce the chance that a single event or downturn will ruin your entire portfolio. Diversification doesn't eliminate risk, but it reduces its impact. It gives your money multiple paths to grow and protects you from putting all your faith and your funds in one place. This strategy requires discipline and patience, but it allows you to stay invested through different market conditions without being overly exposed to one specific area. Another key to managing risk is having a clear investment plan. When you invest without a strategy, every market dip feels like a crisis, and every gain triggers greed. But when you know your timeline, your financial goals, and your tolerance for volatility, you can handle fluctuations with composure. A long-term investor understands that markets go through cycles. There will be ups and downs, corrections and rallies, Reacting emotionally to short-term changes only magnifies risk, but following a steady plan, even when the market feels uncertain, reduces the influence of fear and keeps your financial journey on track. Risk is also managed through proper asset allocation. This means dividing your money between different types of investments based on your age, goals, and needs. Younger investors might take on more risk with a higher percentage in stocks because they have time to recover from downturns. Older investors may lean toward more conservative allocations to protect their capital. There is no one-size-fits-all answer. The point is to find the right balance for your situation and to adjust it as your life changes. When your portfolio matches your reality, risk becomes something you can handle with confidence. Another crucial aspect of risk management is emotional control. Market volatility often triggers fear or greed, both of which can lead to poor decisions. Fear can cause you to sell at the bottom, locking in losses. Greed can push you to buy at the top, chasing returns without evaluating risk. Both reactions are costly. The investor who learns to manage their emotions is far better equipped to manage risk, staying calm during market swings, sticking to the plan, and trusting long-term strategies. These behaviors are what truly protect your portfolio from unnecessary harm. Emergency funds also play a role in managing risk. Having cash set aside for unexpected life events, job loss, medical bills, urgent repairs means you don't have to touch your investments at the wrong time. Many people get into trouble not because their investments failed, but because they needed money quickly and were forced to sell in a downturn. A strong financial foundation supports your investment plan and gives you the space to let your money grow without constant worry. It's not just about what you invest in, it's about building a life structure that supports your investment mindset. Risk is not the enemy of investing. In fact, it's a necessary part of the process. The potential for loss is what makes growth possible. Without risk, there would be no reward. What separates winning investors from everyone else is not that they take no risk, it's that they take smart, calculated, purposeful risks. They accept uncertainty but prepare for it. They embrace volatility but position themselves to withstand it. They don't bet on luck, they invest with wisdom. Even the most conservative investments carry risk. Bonds can default, property can lose value, inflation can reduce real returns. Avoiding risk altogether is not only unrealistic, it's financially dangerous. The goal is not to eliminate risk, but to understand the trade-offs, to know what you're risking and what you stand to gain, to make decisions not out of fear, but out of clarity. When you manage risk correctly, you can invest boldly. Even if you do so cautiously, you can take action, knowing you've accounted for the downsides and plan for resilience. Over time, experience itself becomes a form of risk management. The more you learn, the better your instincts become. You start to recognize market patterns. You begin to understand your emotional responses. You develop confidence in your decisions. This confidence allows you to stay invested through uncertainty, to adapt when needed, and to ignore the noise. You stop fearing risk and start navigating it with intelligence and control. In the real game of money, risk is not a wall to avoid, it's a river to cross. Some days it's calm, other days it's rough. But if you prepare for it, learn how to move through it, and keep your focus on the far shore, you will make progress, you will grow, and you will win. Risk is not something to be feared, it is something to be managed, and when managed well, it becomes the very bridge that takes you from where you are to where you want to be. Investing is more about mindset than money. The greatest investors aren't always the wealthiest at the start. They're the ones who think differently, approach money with intention, and make decisions based on vision, not emotion. While money is the tool, mindset is the hand that wields it. Without the right mindset, even a large sum can be wasted or lost. With the right mindset, even small amounts can compound into lasting wealth. Investing is not simply a numbers game, it's a game of patience, discipline, belief, and mental clarity. A healthy investing mindset begins with long-term thinking. People who succeed in investing are not looking for quick flips or overnight wins. They're thinking in decades, not days. They understand that real wealth grows slowly and steadily. They're not distracted by market noise or short-term fluctuations. They focus on compounding the quiet, powerful force that rewards consistency over time. This kind of thinking requires emotional control. Markets rise and fall, and headlines will always try to stir fear or greed. But the investor with the right mindset stays calm, stays invested, and stays focused. Belief in the process is central to the investing mindset. When you trust how investing works, you're less likely to panic during dips or get swept up in hype. You understand that downturns are temporary, that patience is a strategy, and that success is not defined by a single year's return. This belief allows you to remain committed even when progress feels slow. Many people abandon their strategy at the first sign of discomfort, but real investors know discomfort is part of growth. The mindset that treats every challenge as part of the journey rather than as a reason to stop is the one that wins. The investing mindset also involves delayed gratification. It's easy to spend money, it's harder to save and invest it. But the investor's mindset prioritizes freedom over impulse. It values the long-term gain more than the short-term thrill. This shift in thinking turns investing from a task into a lifestyle. It influences everyday choices whether to buy something now or invest the money instead. Over time, these small decisions compound just like your investments do. The mindset that favors the future over fleeting pleasure builds wealth steadily and sustainably. Confidence is another vital part of the investing mindset. Not arrogance or blind optimism, but quiet confidence rooted in knowledge and clarity. This kind of confidence comes from learning how money works, understanding the basics of the market, and knowing what you're investing in. The confident investor doesn't need to guess. They don't follow trends blindly. They trust their plan because it's built on solid principles. This allows them to move through market cycles without constant anxiety. They don't need constant reassurance because their mindset is already firm. A scarcity mindset holds many people back from investing. They think they don't have enough money to start. But the right mindset understands that the amount you begin with matters far less than beginning itself. Investing isn't about having a lot, it's about consistently doing a lot with what you have. Even small contributions, when made regularly, can grow into significant amounts. The abundance mindset sees possibility. It focuses on what can be done, not what's missing. It turns every opportunity into a step forward and sees money as a tool, not a source of fear. Resilience is another product of the investing mindset. The journey is not always smooth. Markets will drop, strategies will be tested, there will be mistakes, but the resilient investor learns and adapts. They don't quit because of setbacks. They use them as fuel for better decisions. They accept risk as part of the process, not something to avoid, but something to understand and manage. This mental toughness doesn't come from luck, it comes from commitment. It grows each time you stay the course despite uncertainty. Focus is also part of the mindset. The investor's mind is not scattered, it's selective. It's clear about goals, strategies, and values. It doesn't chase every opportunity or react to every headline. It filters distractions and focuses on what actually moves the needle. This kind of focus protects you from the traps of speculation, hype, and emotional decisions. It keeps your investing journey simple and aligned. You don't need to follow the market every day when your mindset already knows where you're going. Investing also requires a mindset of humility. The market is bigger than anyone. No one can predict it perfectly. The wise investor accepts that they won't always be right. They value learning over being correct. They seek wisdom over excitement. This humility keeps them from taking reckless risks. It grounds their decisions and allows them to grow steadily. The ego-driven mindset often tries to beat the market or prove something, but the humble mindset simply stays in the market, trusting the process and letting time work its magic. Adaptability is another powerful trait in the investing mindset. Markets change, economies shift, life circumstances evolve. The investor with the right mindset doesn't cling stubbornly to old plans. They review, adjust, and realign when needed. They don't fear change, they prepare for it. Their strategy is flexible, not rigid. This balance of discipline and adaptability makes them resilient and responsive. It allows them to navigate uncertainty without abandoning their goals. The right investing mindset also values education. It's always learning. It reads books, listens to experts, watches market trends, and reflects on past decisions. It doesn't assume it knows everything. It grows. The more you learn, the better your mindset becomes. It becomes more strategic, more confident, and more capable. This continuous learning keeps your investing sharp and your results strong. It also turns investing from a burden into a passion. You begin to enjoy the process because you understand it. Finally, the investing mindset is about ownership. It takes full responsibility. It doesn't blame the market, the economy, or bad luck. It looks inward and asks what can be improved. The sense of ownership gives you control. It allows you to build a financial life on your terms. It empowers you to make changes, take action, and create wealth by design rather than by chance. Investing is more about mindset than money, because mindset is what makes money grow. It's the mindset that decides to start. It's the mindset that keeps going. It's the mindset that turns uncertainty into opportunity and turns small beginnings into massive outcomes. Money is the resource. Mindset is the driver. When your mindset is strong, focused, and disciplined, even modest investments can transform your life. And in the real game of money, that's the advantage that matters most. Freedom is the real return on investment. Beyond percentages, charts, and profit margins, the greatest reward that investing offers is not money itself, but what that money can give you: freedom. The freedom to choose how you spend your time, the freedom to walk away from stress, to say no to toxic work, and to design a life based on your values rather than your financial obligations. Every dollar you invest is not just buying you more money, it's buying you choices. It's giving you control. It's building a future where your life is not dictated by your bills, your employer, or your fear. People often focus on returns. In terms of numbers, they compare funds, stocks, and assets to find which one performs better over the last year or decade. They chase the highest annual gains or the next best thing. But the most important question isn't what your investment earns, it's what your investment allows you to do. Money invested wisely becomes time reclaimed. It becomes energy preserved. It becomes peace of mind. That is the true return that matters. When you begin investing, it may seem slow. You put away a portion of your income, and for a while it feels like not much is changing. But what's happening behind the scenes is powerful. You're not just building capital, you're building your future freedom. Each month you invest, you move a little closer to independence. That consistency compounds, not only in your portfolio, but in your lifestyle. You begin to feel the confidence that comes from knowing you have something set aside, that you're not living at the edge, that your future self will be better off because of the decisions you're making now. True wealth isn't about luxury. It's about options. It's being able to take time off when you need it. It's being able to help your family without hesitation. It's not having to panic when unexpected expenses come up. It's retiring early or not retiring at all because you're already living a life you love. Investing is the path to that level of autonomy. It puts the power back in your hands. It breaks the cycle of trading time for money endlessly. Instead of working your whole life for survival, you build a life that works for you. Freedom also changes how you experience your daily life. When your investments are working for you, you no longer need to say yes to everything out of fear. You can say yes to what matters. You can slow down, reflect, and be more intentional. Investing isn't just about the distant future, it impacts how you live right now. When you're financially secure, you're mentally free. You're not trapped in survival mode. You're not living with a constant sense of scarcity. That internal shift is one of the most valuable returns investing gives. Many people get stuck in the loop of working for money without ever making their money work for them. They earn, they spend, and they repeat the cycle month after month. But with each invested dollar, you're breaking that loop. You're planting seeds that grow without your direct labor. Eventually, those seeds become a forest-stand ecosystem of income that no longer depends on your active effort. That's what creates freedom, not quitting your job and doing nothing, but having the ability to work because you want to, not because you have to. The earlier you start, the sooner that freedom arrives. That's why investing is not about being rich, it's about being smart. A modest income, invested wisely and consistently, can buy a level of freedom that even high earners without discipline may never achieve. It's not how much you earn that gives you freedom. It's how much you keep, how much you grow, and how intentionally you use it. The goal is not just to have money, but to build a life where money supports your values, your passions, and your peace. Freedom also extends to your relationships. When you're financially stable, you're less likely to stay in toxic situations. You're more able to give generously, support your loved ones, and create experiences that matter. Financial stress is one of the biggest sources of tension in relationships. When you invest in your future, you're also investing in healthier, more fulfilling connections. You're reducing anxiety and increasing the capacity to be present, generous, and joyful. That emotional and relational freedom is priceless, even in times of crisis. Financial freedom creates space. When life throws challenges, illness, layoffs, family emergencies, having investments gives you a buffer. You're not as vulnerable. You have the ability to pause, breathe, and make thoughtful decisions. You're not stuck reacting from fear. That flexibility is worth far more than any single year's return. It's the foundation of resilience, the ability to respond to life on your own terms rather than at the mercy of circumstance. Over time, your freedom multiplies. As your investments grow, you start to experience what it means to live without limits. You realize you're no longer working for survival, you're building legacy. You can fund dreams, support causes, and explore opportunities that once felt out of reach. You can pursue purpose instead of just chasing a paycheck. You can be generous without guilt and live without constant financial pressure. That's what financial independence looks like, not just security, but spaciousness. But freedom doesn't come from one big move. It comes from small, consistent steps. It comes from choosing to invest instead of consume, from prioritizing your future self over instant gratification, from saying no to what feels good now so you can say yes to what truly matters later. Every sacrifice you make today is an investment in your future freedom. And eventually, that freedom will allow you to stop sacrificing and start fully living. Investing teaches you to think differently about time. When you invest, you're no longer stuck in the daily grind. You're stepping into the long game. You begin to think in years, not minutes. You shift from urgency to strategy. That change in mindset gives you freedom long before your portfolio does. You begin to move through life with more confidence, knowing you're on a path that leads somewhere. Powerful. In the real game of money, it's not the numbers on a screen that matter most. It's what those numbers allow you to do, feel, and become. Freedom is not a fantasy reserved for the ultra-wealthy. It's a result that anyone can build with the right habits and the right perspective. It's the return on every thoughtful choice, every dollar invested, and every moment you believed your future was worth more than your comfort. So when you invest, don't just think about percentages and projections. Think about mornings without alarms, work that excites you, time with people you love, and peace that isn't tied to a paycheck. That's the real win. That's the true return. Because in the end, freedom isn't just something you buy, it's something you build. And every time you invest, you're building a life that's fully yours. So the next time you think about investing, don't ask what the market is doing. Ask what you are doing. Ask if you're playing the long game. Ask if your money is working or just sitting. Ask if your future self will thank you or blame you. Because in the end, the real game of money is not played on Wall Street, it's played in your mind, in your habits, and in your decisions. Start small, stay steady, think big, and never forget, you are the most important investment you will ever make.